All right. Thank you so much, Robert. We'll continue to keep an eye on that. Well, the U.S. economy came barreling into 2008, much the same way Japan stormed into 2000, on the brink of crisis. Following a financial downturn in Japan, its central bank cut rates from, get this, 6% down to 0%, and it has remained that way since 2001. Now it is now a 0.5% rate. So with another rate cut expected today, is the U.S. economy headed towards the Far East? With some answers is economist Dr. Thomas Pally, who runs a project called Economics for Democratic and Open Societies, and David Roskoph, founder and principal of Total Asset Performance and Investment Advisory Firm. Good morning, gentlemen.
Good morning.
All right, Thomas, let's get started with you. You see where interest rates are today. We're at 3%. Many expect us to get down to as low as 2%. Are we headed toward the Japan of the late 1990s?
Well, there are some similarities and there are also some differences. The similarities are that we are approaching a sort of a low interest rate environment, and both economies experienced asset bubbles, ours in the housing sector. But the differences are that Japan had two bubbles at once, a bubble in the property market and in the stock market, and the bubbles were also much bigger. And then additionally, I would say that there's one other very important difference, is that we now have the history of Japan's experience on our side. So policymakers have been able to respond faster and I think better than they did in Japan.
David, do you agree?
I do agree. We did have simply one asset bubble, and that was in housing right now. But I think the main point is to realize that we haven't somehow outgrown deflation, that our higher powers that be, the Federal Reserve, isn't beyond the capacity to oversee a bubble and then watch it deflate.
You know, David, I was reading one of the articles that you wrote, Warning Signs of a Modern Depression. One of the things you talked about is what happened to Japan in terms of teetering on the verge of bankruptcy with their financial system, their banking system. You draw many similarities to the current environment we have in the financial system. Tell us a little bit about those comparisons and why they make you so nervous.
Well, I think it's almost embarrassing to think that we have a Federal Reserve which is almost 100 years old, which has presided over such a ridiculous third world lending practice, asset bubble that we've recently seen with real estate.
Explain that further. What exactly do you mean by that? Because in essence here, you said that the Japan's banking system was an asset waiting to happen because of subprime business, and you suggest here that the central bank here didn't, in essence, do its job to make sure that instruments that were being rated AAA, which were in fact not AAA, and we're now paying the price.
Absolutely. I think Japan had a game of musical chairs where they would consider an asset to be still receivable on their books when the company that was supposed to be paying that asset was long since defunct or simply a shell. And we've watched our Federal Reserve, and ostensibly the adults on the playground, oversee the third world lending practices that we've had in America, where we've watched this riotous run-up in real estate, responsible for, say, 50% of the job creation between 2001 and 2006. And then we watched the slew of assets being sent out to people who had no capacity to repay those assets. This was overseen by someone. It's not in a vacuum.
You know, Thomas, some would disagree with that premise that it's a third world lending system. Some, in fact, would argue that what the Fed did this past weekend was probably the best move they've made yet. The question I have for you is, how low can interest rates get, and what examples from Japan could we use when looking at where the interest rate picture is headed?
Mm-hmm.
Well, I'm definitely looking for interest rates to go to 2% today. I do think the Fed will cut by a point, and if I was on the Open Market Committee, I would be advocating that too. Really, everything's in place for a point cut. We've spent a lot of effort trying to put out the fire that erupted last week. I think the Fed has been successful for the time being. Now is the time to make sure that we sort of really douse the fire. It'd be nice to have a big margin between the short-term interest rates and some of the longer-term yields so that you can begin to entice investors back to that part of the spectrum, which will then kind of give some price if If it turns out that there's more strength in the economy, which let's all hope there is, then of course the interest rate cut can be taken back off the table quite quickly. So let's put it on the table right now. And then looking ahead, if it turns out that there's yet more weakness, then I think the Fed will aggressively continue to lower interest rates.
Right.
They've been playing catch up, they have caught up, and now they have to stay ahead of the ball.
All right, just quickly, David, I want to give you the last word here. What do we need to do to solve this problem?
I'm afraid there's not a whole heck of a lot we can do. We continue to look at the Federal Reserve as if it's a magic genie granting us wishes, but they know as well as most economists that they're virtually almost out of bullets. The housing industry is horribly bloated. It's simply going to have to deflate over time. Yes, they will cut interest rates. We've probably seen the first of a series of stimulus packages just like Japan. However, the trough won't last 10 years that did in Japan. It'll probably last 2.5 to 3 years here in America.
All right, David, I'm going to send you a package of some chocolate and some flowers to make you happy.
Thank you.
All right.
I'm not depressed.
Okay, good. I want to make sure. You make it sound like it's so terrible. I hope it's not that bad. But I thank you, Thomas and David, for joining me this morning. I appreciate it.
Thanks, Alexis.
All right, Tom Nile for